Hey everyone, it's Carlo here from the Real Estate Guys, and I'm so excited to announce a new segment that we're going to be doing in 2025. It's called A Closer Look. We're going to be talking about everything real estate and how it affects you, the consumer, whether you're a first-time buyer, a move-up buyer, an investor. If you're looking to refinance your mortgage, we're going to be talking about all the changes that are occurring. We're going to try and really give you some insight into what these changes mean to you, what opportunities they present for you, and maybe some threats you need to be aware of that you need to avoid. And I couldn't be more excited to have our first speaker with us today. We're going to be talking about mortgages, and I've got Dan Patton here from Better Mortgage Select. Now, Dan's not your typical mortgage broker. I know that from experience because I've dealt with you personally with our mortgages. And Dan and his team consistently rank in the top 10 nationwide for mortgage volume. And he really focuses on all those market segments that we talked about. What I really love about you, Dan, is when we were looking for a mortgage, obviously being self-employed, it's tough. The banks don't look at you the same as they might look at an employee. The banks love employees, with consistent income. When you're in the sales business, it's a little bit tougher. And Dan really looks at this and says, he tries to get a better understanding of what your particular situation is and cater the mortgage product to your particular situation. And I really love that about you, Dan. And Dan is, not only do they have access to some of the best mortgage interest rates in Canada, but you're really going to find that his approach to doing mortgages is going to be not cookie cutter and really cater to your particular situation. So welcome, Dan, to our first segment.
It's quite an intro, almost like I wrote it myself.
Amazing. So, mortgages I love talking about mortgages. What a lot of people fail to recognize is that when they start to look to buy a property, there's usually a starting point and an ending point to buying or selling a property.
Yep.
But what people don't recognize is that the mortgage stays with you throughout the journey. And the way you cater that or structure that mortgage is going to affect you for the lifetime of that mortgage. And it really is a significant part to buying and selling real estate. So there's been a number of changes, Dan, just in the last couple of months to the mortgage industry. And I think these changes are going to have some significant impact on various consumers. So let's kind of review the changes first to start. So the first one that I wanted to talk about is that there's been an increase in the limit from $1 million to $1.5 million in the down payment options that are available to you. Can you talk about that change that's occurred and who you think is going to be the biggest beneficiary of that?
Yeah, definitely. So previously, when you were buying a property and you had less than 20% down, there's mortgage insurance that comes into play. And mortgage insurance is who insures the bank's money in case of default. So when you're buying at less than 20% down, it doesn't matter what bank you go to because they all have to get mortgage insurance in a sense that the mortgage insurer is the one making the rules. Well, the mortgage insurer had a rule that if you were buying at a purchase price over $999,999.99, you could not get CMHC insurance on that property. So buyers who were buying with less than 20% down were limited to under $1 million. So CMHC's come out and they've extended that. They've come out and they've said, we are now going to allow purchasers to purchase up to $1.5 million and will insure mortgages based on the minimum down payment. The minimum down payment these days is you can put 5% down on the first $500,000, and then you have to put 10% down on the amount above that. So if you just do the math quickly on a purchase of $1.5 million, if you have $125,000, you can now purchase that property and get insurance through CMHC. Now, there's a caveat, it's difficult to qualify for that. Generally these days people qualify for maybe 5 times their income, if you're buying at 5 or 10% down. So you have to have strong income to qualify for this program. So who's it going to affect the most? Well, listen, you're looking in, high populated areas, Toronto, big city type places where the property values are probably pretty high, where you're looking at people that have strong income. I mean, that's really who it's going to affect the most. There's not a lot of first-time home buyers buying over that price range, right? So that I don't know that that particular rule is there to help the first-time home buyers. It might, but there's not many buying at that price. So that's it. They basically jumped from the $999,999.99 up to $1.5 million.
So basically, a first-time buyer can get into the market if they have strong income, obviously, and not have to come up with a $200,000 deposit, let's say on $1 million plus property, and the down payment would be reduced significantly down to, let's say, the 125 range.
Yeah, and this isn't even limited to just first-time home buyers. I was pointing that out more of a segment that I don't think it's going to affect much. It's probably going to affect more resale sellers. But this is available to all buyers if you're buying with less than 20% down. A lot of people think that buying with 5 or 10% down is tied to first-time home buyers alone, and it's not. You just have to be buying an owner-occupied home to be buying at 5 or 10% down. It could be your second or third owner-occupied home.
Yeah, and that point is very important to point out for sure. Working in the real estate industry in the Toronto market for the past 30 years, I know that segment between 1 and 1.5, especially here in Toronto, is a pretty high producing area where a lot of the activity takes place. So I do see that having some significant changes. A lot of times buyers or people think that if a program helps first time buyers and you're maybe somebody who is an empty nester, it's not going to help you. But you have to realize that the real estate process starts at the first time buyer end and affects everybody up the food chain.
Yeah.
Because if the first time buyers aren't buying those move up properties, then those move up buyers are not buying the luxury homes that might be for sale. So all of these changes have significant impacts for sure. Okay, let's talk about the second change that's taken place. And there's been a change in the amortization periods from 25 to 30 years for first-time buyers. Can you talk a little bit about that?
So that's a good one. So previously, again, when you were buying an insured mortgage, so buying with less than 20% down, you were limited to a 25-year amortization. So they've come and changed that effective, I think it was December 14th, 2024, the 14th or 15th. They changed that rule. So first-time home buyers can now qualify for a 30-year amortization. So effectively, how does that affect the buyers? Well, on one hand, your qualifying goes up, because when I'm running somebody's pre-approval on a 25-year AM, their borrowing power is less than if there was a 30-year amortization. So right away, you're going to get an increase on pre-approvals for people who are out there shopping. Secondly, you're going to make their payments more affordable. Monthly it's going to be more affordable. You're looking at a payment chart on a 25-year amortization. You're going to have again a much higher payment than if it was on a 30-year. Depending on the mortgage amount, it is relative to the change. Now, an interesting thing about that is, what's a first-time home buyer, right? A first-time home buyer, we think it's somebody buying their first home. Well, that's not necessarily a first-time home buyer. You could be coming out of a divorce. You could be someone who hasn't owned a property in 5 years, and you can qualify as a first-time home buyer.
I think that's a great point, because a lot of people think that to be a first-time home buyer, it's got to be your first place,
right.
But it doesn't have to be.
No, it doesn't have to be.
Well, that's good, because mortgage payments are going to be less, and potentially they could qualify for something a little bit more.
Yeah.
And that will help the buying segment too as well. Okay,
Yep.
Great. Let's talk about changes to refinancing homes to build additional accessory suites or potentially a laneway suite.
Yeah.
What are the changes that have occurred there?
Okay, so this is a big one. As of January this year, January 15th, you now have the ability to refinance and pull money out of your property past that 80% threshold, okay? It's been about 20 years in this business now that you have not. If you're trying to refinance your house through a financial institution, a bank, you can't access more than 80%. They won't do it. So now the government has come out and CMHC is changing their policy to allow people to refinance, to pull money out of their house up to 90% of the value of the home if those funds were used to complete additional dwelling units. So, converting a single family home to a duplex, adding a laneway house, an ADU, an attached dwelling unit. These are things that they will reimburse you on. Now, so that's important to remember. They're not financing the construction of this stuff. If you have to provide the quotes, you have to provide the verification that the work was done. This is a reimbursement program. So similar to a purchase plus improvements. If you've ever worked with a purchase plus improvements, there's a program available now where if you buy and you get it cleared up front, you get the contractor quotes for the work that's going to be done, you can actually qualify for what's called purchase plus improvements. Now how that works is you buy the house for the purchase price, you finish the renovations you're trying to do, and then the bank will reimburse you the costs of those renovations. So this is similar to that. They will refinance up to 90%, which is a big deal. Remember, we haven't gone past 80%.
Yeah, it is.
So they're going to 90% now on owner-occupied homes. So that's key too, right? A lot of investors are buying, duplexes, maybe converting those to, triplexes or ADUs. Not for rentals, only owner-occupieds at this point.
Okay, and I think that's a big change because we've seen a big move to multi-generational type of living.
Yeah.
So if you've got older parents who are looking to maybe move in with you for care, I think that's a really huge change.
Yeah.
Maybe, we're finding that people are living in their homes a little bit longer than they used to, and providing the income from those additional units certainly helps financially to any family. That's fantastic. Really great program.
Yeah, it's a good program. I've been doing this over 20 years now, and I most of my career they took product away. When I first started, you could actually refinance to 95%, believe it or not.
I remember those days,
right?
Dan.
And I stopped that. So it's nice to see change in the opposite direction, where they're adding programs now to try to help buyers, qualify to buy and, get reimbursed for creating, extra housing.
Amazing. Well, let's talk about the next change, and one that's near and dear to me because we're going to be refinancing a mortgage this year. So they've made some changes to people who are refinancing their mortgages with respect to the stress test. Can you talk a little bit about that?
Yeah. So traditionally, when you had a renewal coming up, depending on what you're trying to do on renewal, if you're just trying to renew and keep a low rate, sort of keep your amortization on schedule, then your bank had a huge advantage over a lot of other banks, because to renew with your bank is very simple. They're just sending you something in the mail. You pick a term. You might call me and ask me my advice, and we talk about that, but it's a pretty simple process. There's no qualifying. In order to shop that mortgage around to another lender, you would have to go through the document process and qualify at the stress test. Now, the stress test is 2% above the contract rate, right? So think about that. Let's just say you're renewing with a big lender and they're just offering you, a certain interest rate for you to pick. And now you have the ability, at that point, it was tough to go and leave because you'd have to go to another bank. That other bank would have to qualify you. Let's say the rate was 3.99. You'd have to qualify to move that mortgage at 5.99%. That's the stress test.
Big difference.
So it was tough for people to move from one financial institution to another financial institution. One, because of document collection. That's, generally, nobody likes the document part of it. But just from a qualifying standpoint, it made it difficult. So your existing lender had a bit of a stranglehold on where you could go in a sense. So the government's come out now and they've said, well, look, if you are going to move your mortgage to another lender on renewal, we'll waive the stress test. You can now qualify at the contract rate. So again, if you're getting like a 3.99 or 3.5 or 4.5, whatever it is, you can qualify now to borrow that money at the same rate. You don't have to apply the 2% qualifying rate, which was making it tougher.
That's amazing. I'm so excited about that change.
Yeah.
As I said, we're going to be refinancing a mortgage this year. And that has a tremendous impact on our ability to go to other lenders and really see what our options are in comparison to what we thought, in the past. We were kind of locked in and didn't really have much movement.
And it's interesting because to make it clear, refinancing and restructuring that renewal would require a stress test, because a refinance, if you're pulling money out or you're setting up a line of credit, that's going to that kicks in the stress test. This is simple renewals, and a simple renewal, in a sense, is when you leave the mortgage amount the same, the registration of the mortgage, the amortization, everything stays the same, and you're moving it from one lender to another. So that's a big difference. You got to make sure it's not a refinance.
Yeah, that is a great point. Thanks for bringing that up. Okay, we've talked about some of these changes, and honestly, like most of the times when governments introduce programs, I look at them and I don't get the sense that they're going to have any impact on the market. But these are 4 changes that I think are really going to have some impact. And, there's no question that the real estate market is struggling right now. And we do need some programs to get, people excited about real estate again and, just making sure that they find the best situation for themselves. Okay, so the big question, everybody's wondering, Dan, what's happening to interest rates? We know they've been coming down. Actually, I think over the last 6 months, they've come down about 2%.
Yep.
Is that correct? Okay. So where do you see, well, first of all, where are interest rates right now? And where do you see them headed in the next 6 to 12 months? And, keep in mind, everybody, that nobody has a crystal ball. I mean, we're giving our best educated guess. But what do you see or what are you hearing in the marketplace?
So, volatility. And that's the key word here. When we're talking about fixed rates, they're very volatile right now. Fixed rates are based on the bond yields at the banks. And bond yields are very sensitive. They can move on speculation, they move on rumors, they move on threats of, tariffs and things like this. So volatility is the key when it comes to fixed rates. Now, variable rates a bit different. Variable rates controlled by the Bank of Canada, and you're right, for the last 6 meetings, we've seen decreases in variable. So one common misconception that I find is most people believe that fixed and variable rates move in the same direction, meaning if one's heading down, the other one's heading down.
Yeah.
If one's heading up, the other one's heading up. And generally, if you looked at it from a sort of macro level, they would follow a similar pattern. But if you looked at it from a micro sort of vision, you'd see that in times like this, they can go in different directions. And that's sort of what we're seeing right now. We've seen fixed rates overall in the last year are down about 1.5, almost 2% in some cases.
Okay.
A year ago, people were taking 3-year fixed rates at maybe 6%, somewhere around there. And you can get down maybe around 4.5 right now.
For a fixed 5-year rate?
Yeah, for a 3-year or a 5-year fixed rate, you're going to be somewhere around 4.5% right now. Now that was a little lower at the end of last year. Q4 of last year, we saw fixed rates starting to come down. We saw them testing levels of 3.99. But the bond yields have steadily risen. They kind of bounce around. And from Q1 of what we're seeing now, we're seeing the bond yields up and we're seeing the interest rates up.
So the fixed rates are actually inching up a bit.
Inching up. They don't move at the same level. It's not like it's always a quarter point like the variable rate, but we're seeing fixed rates inch up a bit right now. Now that might level off. Again, the threat of tariffs in the short term could bring down fixed rates.
Right.
Competitive spring market. Wouldn't be the first time the banks in the summertime started advertising lower fixed rates. So certainly I think the overall picture of interest rates for fixed is a downward trend. How far that's tough. We see a lot of economists, we go to a lot of conferences to get this information, to relay it to the audience. And from what we're hearing, 3.5 to 3.79 was probably going to be the bottom of what we're going to see over the next few years.
Sorry, 3.5 to
3.79.
Okay.
Now that's an optimistic view of where anything can happen, but that's an optimistic view. A pessimistic view would be 3.99 and above, 4.25. That's probably the lowest we're going to see.
Okay.
So the reality is probably somewhere in the middle. We've been telling people for the last 18 months that if you can get 3.99, I would lock in anything that has a 3 in front of it. I would take a real hard look at locking that in.
Okay.
So that's where you're sitting on fixed rates. Now again, I'll jump to variable. Variable today is sitting at 5.2%. That's prime rate. Prime rate is at 5.2%. Prime rate is based on the Bank of Canada's overnight rate, which is at 3%. So we typically get a discount to the Bank of Canada's variable rate, prime minus 50, prime minus 60. So if prime is 5.2% and I'm prime minus 50, I'm going to have an effective rate of 4.7%. Now again, a lot of predictions on where the overnight rate will go. The high end predicts that the overnight rate might stay here. That's it. No more drops. A more optimistic approach from some of the economists might say, like RBC says, it might drop another full point by the end of the year. So, I think you're definitely going to see some drops. I think it's going to be somewhere around another 0.5 point to 0.75. I think you're going to see prime rate continue to drop. But what's interesting is you're seeing, for the past few years, you've been in mortgages and real estate a long time, just like me. A normal market, variable rate tends to be lower than fixed rates. And we haven't seen that in the last few years. Variable rate's been higher.
Very atypical.
Right. It's abnormal. It's not normal. So it's very tough to sell a variable rate to a client when you have the risk of rates going up, even though, and variable rate was higher than fixed rates. So I mean, imagine last year, if you had to make a rate decision on a 3-year fixed rate at 6.29 or a variable rate where you didn't know if it was going to go up or not at 6.75, what are you going to take? Yeah. Most people took the fixed rate, right? And now a year later, you're sitting here and fixed rates are at 4.5%. The penalty cost is too much to break it, and they're stuck. And I have empathy for that. It was a very, very tough decision. But the point I guess I'm making is that we're starting to get back to a more normal market where the variable rate now is almost on par with those 3 and 5 year fixed rates. So another 1/4 point drop to variable, if the fixed rates sort of stay flat for a bit, you're going to be back to variable rate being lower than fixed rates. And that's a more normal market when variable rate is lower. Yeah. So I think the overall outlook's good, I think we're going to continue, trend of lower rates. I think you could see volatility with the fixed rates for sure. The looming threats of tariffs and, deportations, these are things that can cause inflation to go up over the long run. So we have to be careful. This is, again, the first time I'm seeing people look at 5-year fixed rates again. We haven't seen 5-year fixed rates, anybody taking those in the past 2-3 years. So you're seeing a return to a more normal market in a sense. I don't know that we're going to ever see those amazing 2%, 2.5% interest rates again, but we had a very healthy market in 2019. And if we go back to interest rates in 2019, pre-COVID, this is roughly where we were, high 3s, low 4s is roughly where we were, and we had a healthy market.
Being in the real estate industry for 30 years, honestly, these rates are great.
Yeah.
When I think about when I first got in, it was very typical to get rates anywhere between 7 and 10%. And they've been steadily declining, obviously, over the years. So, even though rates may have gone up, they're still very competitive when you look at things historically. So, question for you. When you're working with a client, what is the number one factor you look at when it comes to going either short-term or long-term? Because people are, like you just mentioned, if you took a 3-year rate at 6%, now you're kicking yourself. What do you typically tend to recommend to clients to make that decision, help them make that decision?
It's a really good question, and you have to be willing to adapt. That's key. There's a time where the variable rate makes sense. There's a time where the 5-year fixed rate makes sense. There's a time where the 3-year might make sense. So you have to have a strong understanding of the market. I'm no economist, but you have to understand, the basics of the economy and inflation and things like that. And these are things we use to guide us. We listen to the things we're told by our government. Sometimes they're wrong, oftentimes they're right. But we take the direction from the government. We take direction from the economists. We see the signs in the market, and we try to advise our clients the best. I think it's from a base level, if we're talking to first-time home buyers for the most part, they're a little less, open to volatility in a sense. They want to lock in. They want to just know what their payments are going to be. So I think for first-time home buyers, it's more of an easier discussion because they prefer fixed rates. Maybe a seasoned buyer might be more open to variable. I think if I'm talking to somebody who is thinking of selling their house, that's one thing I always want to consider, the penalty. When you take a variable rate, the penalty is always 3 months interest. So you can bank on your penalty, you can calculate it. When you have a fixed rate, the penalty is based on either 3 months of interest or interest rate differential, whichever is greater of the two. That's what the bank contract says. And interest rate differential is based on the posted rates at the time you got the mortgage versus the posted rates at the time you want to break the mortgage.
It can be significant.
It can be significant. Well, you look at people again, unfortunately, who may have locked in at 6% last year, and they've got 2 years left on their mortgage, and they want to break it at, and take 4.5% today. Well, the bank's going to figure out, well, look, we loaned you that money for 3 years at 6%. You want to break it early. We have to go get that money back and lend the money out at a lower rate. We're going to figure out what that penalty is, and we're going to charge you, the client. That's effectively what they're doing. So they're getting their money back. Oftentimes, it can sometimes, but oftentimes it doesn't make sense to pay that big penalty. So when I'm advising a client, penalty for sure, what is it you're trying to do with this property? You're going to be here for the next 3 years, 5 years? Do you want flexibility? So
that's what I really loved about working with you, Dan, because you do look at what the client, what they're looking to accomplish. And try to cater that.
Yeah, much like a realtor. I mean, you're trying to find, the house that fits them. You're not trying to just pick a house and here you go, here's the house I chose for you, right? That's not how a mortgage should be set up. You have to understand the client's needs. You have to understand what is it they're trying to do and cater the mortgage to that.
Yeah. So I've heard that over the next year, I think there's about 1 million mortgages coming up for renewal. And over the next 2 years, I think in total about 45, I can't remember exactly the number, but 45 to 55% of the mortgages are coming up for renewal. When do you recommend that somebody who's going to be renewing a mortgage, when do you recommend they start that process?
Well, your bank will allow you to start the process generally 6 months early. Okay, so you can get out of your mortgage 6 months early.
Without a penalty?
Without a penalty with your existing lender.
Right.
To leave 6 months early and go to another lender, you're going to pay the penalty.
Of course.
Now, it's interesting though, because if you talk about, you're right, a lot of renewals are coming up now and next year. Why is that? Well, because most people were taking 5-year fixed rates or 5-year variables and then converting them in 2020 and 2021 when interest rates were down at 2%, maybe a bit higher. So you've got all of these people coming up for renewal in 25, 26. So would I advise those people to reach out to their bank and renew early? Depending on their scenario, it might make sense. I mean, that's one of the things you talk about. But from a general standpoint, no, you want to ride that rate right out to renewal. Why would you break 2% or 2.5% right now? Ride it till renewal. You can get rate quotes from your existing lender.
Right.
But one thing that, is interesting too is your existing lender oftentimes won't offer you a rate hold till renewal. So if you're 4 months out, let's say, and you've got 1.99 as your rate, and you go to your bank and say, look, I'm a little worried rates are going to go up right now. Can you lock me into a rate hold so that in 4 months from now, when my renewal's up, I'm good to go? Your bank won't do that. Okay? You have to actually go get a rate hold from another lender. And we get a lot of clients that will come and see me and say, Dan, my bank won't give me a rate. They won't
give you any rate hold.
No, they want me. They maybe for a week. They put a timeline on it. They go, these rates are only valid for a week. So do you want to renew early or not? Otherwise, these rates aren't going to be here anymore.
Okay.
So it puts a gun to the client's head in a sense. They have to make a quick decision. So what I try to do in those scenarios is we'll take those clients. Let me go get you a rate hold at another lender, because another lender will hold your rate for 120 days. So I can be the backup in those sense. I can go process an application for a client like it's a renewal, go and get a rate hold at another lender so that we can make sure that if rates did go up, I've got you protected at this other lender. Amazing. And then we can let your existing mortgage run its course until renewal without that fear that rates are going to be jumping up.
So to get that rate hold from the competing lender, do you need to go through the application process?
We do.
Okay.
Because these days, banks they call it a live deal. And a live deal is when you're submitting a deal and they want all their documents up front. I 20 years in this business, I remember I used to, okay, well, how much do you make? Tell me your down payment and there's your pre-approval and we'll send everything to the bank when you get the deal accepted. But it's different now. The banks are system and they want process. And part of that process, and listen, I can't disagree, the efficiency of having the documents ready to go up front is important. So when I'm submitting a deal to the bank, yes, they want the paperwork up front. But I mean, again, to the client, if this is your protection against interest rates going up. So I mean, if you're up for it, you just got to get me the documents and I'll go get you that rate hold.
But Dan, you're going to have to get the documents ready anyway, so you might as well start early, right?
Yeah, well, that's what I say, right? The more time you leave yourself, to me, typical mortgages will take about 30 days to process. Now, it can take longer. I mean, you can do them faster as well. But if you're inside 30 days and you've left it to the last minute, you're going to feel like you're scrambling around for documents.
Yeah.
So you're right. Not 60 to 90 days, 120 would be ideal because that's the rate hold. So if somebody was coming to me and said, Dan, when should I start my renewal process? I'd say 120 days because that's the length I can get that rate hold.
Amazing. I know when we're working with clients, the first step we always recommend is to call Dan to make sure that they've got that approval in place. Because once you have the approval, you know exactly what options you have available to you. If you start shopping for a property early before getting that approval, you might be disappointed that the numbers aren't going to work the way you think they're going to work. And I think having somebody speak to a professional up front about their mortgage options really sets everybody up for success to ensure that everything goes smoothly along the way. And I got to tell you, Dan, prepping those documents, not a fun process. So you might as well get it over with right from the beginning. I gotta say.
I get it.
Where do you see the biggest opportunity right now in real estate? First of all, do you still see real estate as a good investment?
Yeah, I mean, I love the investment of real estate. It's tested. It's to me, real estate is the safest. When you look at the history of real estate, you're always going to have fluctuations in the market and, a little bit of dips and dives, but it's everybody's one regret in real estate is why didn't I buy more? It doesn't matter whether you're 30, 40, 50, why didn't I buy more when I was younger? So I love the investment of real estate. I think this brings an interesting opportunity. I've been in this a long time, so I've seen different markets. I look at the numbers of houses that we have. I look at the amount of people looking for houses, and I can see that there's a shortage. I mean, there's no secret. There's not enough supply and demand. So you can say anything you want about economics, but you can't take away supply and demand. And we have a shortage of supply and an increase in demand. So I think the overall picture of real estate is the trajectory is up. You're going to have, again, with interest rate sensitivity, you're going to have fluctuations, but it just brings an interesting opportunity. I'm not somebody that's out there saying, you got to get out there and buy now, right? This is the time. But I think that if we were to look back on this period of time, in 10 years from now, we will have seen the opportunity that came right now. Unfortunately, when you have these crazy high interest rates, and things become unaffordable, you're going to have more things hitting the market. It's going to switch from a seller's market to more of a buyer's market. And I mean, when was the last time you saw more of a buyer's market than this?
I've been doing this 30 years, and the only buyer's market I really ever experienced is from 1993 to 95, 96, when I first got in. And, for the last 25 years, it's pretty much been an uphill battle. So
that's my point too, right? And same thing for us. So I don't see that changing at all. I think this presents an opportunity. For the last 5 years, almost you couldn't present an offer with conditions. And now you have the opportunity as a buyer to do that. You have the opportunity to look at multiple houses, have conditions, put an offer in with the contingency that your house has to sell. So, and that will change as the market heats up, as we hit into spring and summer and, we see more people coming to the market. That might change. But I just think it brings an interesting opportunity over the last 6 months that, we may not see again.
I couldn't agree more. It's really tough to take action when there's a lot of doom and gloom or negative talk out there, but I've got 3 kids. They're starting to enter that age where I'm trying to encourage them to really look at real estate and buy, and I see this market as a real opportunity for them. Because if I hear from clients, why don't we wait? We're going to wait till interest rates come down. Maybe inflation comes down. And obviously, you've got to be financially stable. I mean, that's a given. But if you have some consistency and have some confidence in your situation, I think this is absolutely one of the best markets to consider getting into the market. It's funny, back in 22, when, we listed property and we'd have 30 people lined up at the door to buy properties, giving sellers $200,000-300,000 grand over the asking price and just throwing money at people. Everybody wanted to buy real estate. And yet today, when we have nobody at the door submitting offers, we can't get anybody interested. And if you really think about it, it's the herd mentality. And if you really think about it, it doesn't make sense to me. This is absolutely the best market to be looking to get in, because there's a real opportunity here for sure. Okay, let's talk about why would I use a mortgage broker? So if I'm a consumer, aren't I going to get a better deal if I go to my bank and deal with them personally? Why would I use you?
Okay, so that's a question we get every day, and I always say to clients, we're a really good place to start your shopping, okay? Why? Because a mortgage broker is different than you could go to your bank. You could take the time and go to every bank and figure out what you qualify for and figure out who's going to give you the best interest rate and deal with the different people there. Or you could come to a mortgage broker who's essentially a one-stop shop for that, and we shop the mortgage around and we go to the different lenders and figure out who's going to have the better rate for you. That's the job of a mortgage broker, to save you time, make it more efficient, and build that relationship. Now, another side of it is customer service. You know, we're essentially sales. I mean, we want to be available when the bank's not. We want to be available by text. We want to be available after hours. We want to be available on weekends. You know, just like a realtor, if my client has a question on the house, they're going to call their realtor. If my client has a question on mortgages, I want them to text or call me. So availability. So you combine interest rate with customer service and, you know, no cost as well, right? Mortgage brokers, when we're working with banks and we're arranging these things, there's no fees to the client. So it's a free service to the client. It's something that they can have a one-stop shop, have a dedicated mortgage professional advising them. You know, I'm independent. I don't favor one bank over the other. So I can give impartial advice to a client on why maybe we go to this bank, why maybe we might avoid this lender and go here and do it this way.
Right.
So that impartial advice really separates us from the bank. So when you combine all of that, you know, I think we're a really good place to start for people who are thinking of buying their first home, and people who are thinking of renewing or refinancing, because we're advice-based. We're a no pressure, no cost approach of understanding your options. That's it.
Yeah.
And we, as brokerage, we're compensated by the bank directly. That's how we get compensated. So there's no fee to the client.
Yeah, I mean, whenever we're talking to our clients, we always recommend that they start with a mortgage broker because, you know, even if you walk into a bank, I find that the product knowledge that the bank has of their own product is lacking. You know, and not to mention the availability. Like, try getting a hold of a banker after 5 o'clock, you know, on a Friday. It's next to impossible. So
they used to have mortgage specialists at the bank and different specialists, but I think what they've done now is they've gotten rid of the independent specialist and condensed it into more of one role and put all of these different things under one person. So you're right, you're going to get, listen, no doubt, you're going to get talented people at a bank, right?
For sure.
You're going to get good people, but that's, and you're going to get bad people. I mean, that's the reality of the bank. You know, you never know what you're going to get. So the mortgage broker, if you're built on the right, you know, on the right beliefs and you're honest with people and you treat them with respect, then it's a natural fit for clients, just like with the realtor, to want to work with a mortgage broker.
yeah, makes sense. You know, the mortgage field really is very complicated, and you have to have a system established with the mortgage process to ensure that you get the right product for yourself. And I think sometimes, you know, as consumers, we might not recognize that or see that from our side. And having somebody that you can depend on to take you by the hand and lead you through that process, I think is really critical for sure.
You know, I agree. It can be a very overwhelming process. The thought of a mortgage renewal to people can feel very overwhelming, or a refinance. So a lot of people would take the opportunity to avoid that. They don't want to deal with that. So I get a lot of clients that come to me and say, Dan, I don't know anything about mortgages. Okay, I'm a roofer, or I'm a police officer, I'm a fireman. Like, this isn't my specialty. Yeah. And I love that. I encourage that. It doesn't need to be their specialty. Just get me what the documents I need and let me be the person that does this for you. I'll deal with the stress. I'll deal with, you know, the banks. You let me handle that stuff for you. And oftentimes we can get them, you know, like you mentioned, better opportunities either at their lender or sometimes at other lenders.
Yeah. I found one of the real big benefits when we experienced your service was really when we had that first call with you, I felt like I was in the hands of a professional, and I don't know how to explain it to you, but I really felt comfortable knowing that I'm going to let Dan deal with this. I'll provide the documentation, and we're in good hands. That's just the overall feeling Lena and I had when we were working with you. And then, you know, obviously one of the reasons why we work together, and I don't know. There's something really comforting in that.
No, thank you. I appreciate you saying that's exactly just like you as an agent. That's exactly the energy we want our clients to feel. We want them to feel safe. We want them to feel trusting, and we want them feeling like we're looking out for their best interest.
Amazing. Dan, before we wrap up here, is there anything that we haven't talked about that you'd like to share, or maybe give something for the audience to think about?
Yeah, you know, one thing I would say is It's tough times. Interest rates are high. Costs have gone up. You know, if you're someone out there who is struggling with mortgage payments or debt load, it's better to get ahead of those things than to let them take control of your life.
Right.
There's no embarrassment. There's no, you know, we understand that things happen in life, and you need to, as strongly as I believe, you need to stay ahead of these things, because one thing that can happen specifically when there's debt issues is these issues can compound, and if debt becomes an issue and that starts to affect your credit, it's going to be very difficult to bring that mortgage back to a bank and pay off those debts at a reasonable rate. So you always want to make sure that if you can, that you're ahead of these things. You know, reach out to your mortgage professional, reach out to your bank if that's who you trust. You know, reach out to these people and get an assessment before things go to a point where you can't do it. So don't be shy. You know, it doesn't mean you have to do a refinance, doesn't mean you have to, but talk to somebody and get professional advice if you're feeling that struggle.
Yeah, getting ahead of it is really critical for sure. We hope that you've enjoyed this segment of A Closer Look. It's the first one that we've done, and we're going to have many more throughout the year. In an age where, you know, things are kind of like 30-second sound bites, we really feel that taking a closer look at things that are happening in the real estate industry and talking about how that's going to affect you and giving you hopefully some in-depth analysis, you're going to find to be very helpful. So Dan, I want to thank you so much for being our first guest.
Oh, my pleasure.
You're going to go down into history. Yes.
What an honor.
And for everybody, for any of you that are looking to get pre-approved, reach out to me and I can definitely put you in contact with Dan. And as I mentioned earlier, if you are thinking about making a move right now, I'd highly encourage you to really think about it. I know it's tough to be, you know, to have that mindset where people are not buying right now, but you know, if you're really serious about getting into the marketplace, I can't think of a better time than right now. So you know where to reach me, and look forward to our next segment of A Closer Look. Till we meet again, make it a great day.